Half its customers stopped going out, sales fell immediately. Constellation Brands owns Modelo, Corona, and Pacifico in the United States. For years, that was the best business in American beer, not a good one, the best. Roughly half of its United States beer revenue comes from Hispanic drinkers. Half, that is not a segment, that is the company. Then Constellation told investors something almost no consumer business ever has to say out loud. Its customers had stopped going out, not because a six-pack got too expensive, because they did not want to be seen buying one. This is not an analyst's theory. It sits in Constellation's own risk disclosures and on its own earnings calls. Every bad quarter a company has ever had came with a lever. Prices come down when customers are broke. Advertising goes up when customers forget you. There is no lever for a customer who does not want to be seen in a shop. 5 methods are about to disagree violently about what that is worth. 5 methods sit tonight. Greenblatt, Buffett, Ackman, Graham, Druckenmiller. We run their rules, not their holdings, and none of them is claimed to own this stock. Start with what is physically in the cooler. A gold Modelo Especial can, Corona in clear glass because the lime has to show, Pacifico in blue, Victoria in amber. 4 Mexican brands that Constellation sells inside the United States under a perpetual license it bought in 2013. Marvin Sands started this company in 1945, selling bulk wine out of upstate New York. 80 years later, the engine is a brewery at Nava in Coahuila, among the largest on Earth, with a second site rising at Mexicali for about $1.5 billion of new capacity. Modelo Especial was the #1 beer in America. In September 2025, Michelob Ultra took the volume crown. Read that carefully. Modelo lost volume. It still leads on dollar sales. Losing cases while holding price is a completely different injury from losing the customer. So that is the business: real brands, real plants, real pricing power. The number that matters here is depletions, not what Constellation ships to its distributors, what the distributors sell on to shops and bars. It is the closest thing this industry has to a live reading of whether anyone is actually drinking the beer. The series runs like this: down 2.5%, down 3, down 2.1 for the full year, then up 0.6, then down 0.3. 2 years down, 1 quarter up, then flat. A single positive quarter inside a run like that is not a turnaround. Stanley Druckenmiller's method will refuse to touch this for exactly that reason, and he has not spoken yet. Constellation does something unusual with its own data. It tracks the zip codes where more than 20% of the population is Hispanic, and it reports what happens there against the general market. Those zip codes are where that half of the business lives. Results there came in materially worse. That is a cross-section inside one country. Same economy, same shelf price, same weather, same beer. The only thing that changes between those 2 sets of zip codes is who is standing in front of the cooler. Evidence that clean is rarer than it sounds. It is not only the company saying it. The numerator household panel shows Hispanic household spending growth falling from 3.2% to 0.8. Now look at the other line. White households fell from 4.7 to 3.3. Both groups pulled back. Anyone who quotes you the first number without the second is selling you something. And the part most coverage skips: beer was already going backwards before any of this. People drink less than they did. Moderation became fashionable. GLP-1 drugs blunt the appetite for alcohol. Younger drinkers start later and stop earlier. No study separates those 2 effects cleanly. The direction is strong. The precision does not exist. We will say that out loud rather than pretend to a decimal nobody has. So the stock, down roughly 40% across calendar 2025. Measured from the March 2024 high, it is closer to 50. Which number you use decides how the story sounds, so the base period goes on screen and you can pick. That is the evidence, correlational, company reported, not isolated. And then, in April, Constellation did something that made the argument about the evidence almost beside the point. 8th of April 2026, Constellation withdrew its own 2028 guidance. The reason it gave was limited near-term visibility. Companies defend guidance. They cut it, rebase it, explain it away, blame the weather. Walking away from a multi-year forecast entirely is a different act. It says the range of outcomes is no longer estimable by the people who know more about this business than anyone alive. And the stock went up about 7% that day. The market did not read it as capitulation. It read it as honesty, finally. Nicholas Fink arrived as chief executive the following week. He inherits $4 billion of buyback authorization, a balance sheet built for a different decade, and a demand problem he cannot advertise his way out of. The risk factors in the annual report name this exposure directly in the company's own language. We are describing that section rather than quoting it because the sentence belongs to the filing and not to 7 articles copying each other. There's a second cost line people keep throwing at each other: aluminum tariffs on the cans. The figures in circulation do not reconcile, so the honest answer is tens of millions and not a decimal. And in April 2026, malt beer was carved out of the tariff, which takes the tail off it. So added up, $1.5 billion of new capacity going up at Mexicali for demand that is going down, and a management team that has stopped pretending it can size the gap. What is that worth? Here is the problem with every framework at this table. A moat prices whether a rival can take your customers. It was never built to price whether your customers are afraid to leave their homes. Same company, same numbers, 5 different places. Start with the method that refuses to ask why the price fell.
The formula asks 2 questions and deliberately refuses a third. What does the business earn on the capital it genuinely needs? And how cheap is that stream of earnings today? It never asks why the price fell. That refusal is the method. It is not a flaw in it. Return on invested capital around 11.5%. Enterprise value to EBITDA around 10.5 times. Against its own history and against its peers, that ranks. A cash-generative brand owner beaten down by sentiment is precisely the animal this screen exists to catch.
So the formula buys mechanically, without an opinion about immigration, beer, or anything else, and it would buy again tomorrow.
The brand test passes, and it passes easily. Nobody walks into a shop and asks for a lager. They ask for a Modelo. That is the working definition of pricing power, and the dollar share says it is still intact even after losing the volume crown. A wonderful business temporarily out of favor is a shape this method has bought before and been rewarded for. American Express, after the salad oil scandal, is the textbook case. It is comfortable buying into fear, provided it can see the far side of the fear. But this method needs to see a decade, not hope for one, see one. And the people running this company have just said formally that they cannot see 3 years. You cannot discount cash flows you have been told in writing are not estimable.
Interested, sized small, which for this method is a polite way of saying not yet.
The activist case is stronger than people expect. A new chief executive with a mandate, $4 billion authorized for buybacks, and the dual-class share structure that protected the founding family was dismantled in 2022, so the votes actually exist now. Governance fixed, capital returnable, management replaceable. On paper, this is exactly the setup this method hunts for. And not one of them reaches the problem. Every lever an activist owns points inward at the company. This problem is outside it. You cannot restructure your way to a customer whose behavior changed for reasons that have nothing to do with your beer.
Cautious, not because the plan is wrong, because there is nothing for the plan to grip.
On earnings, it looks cheap, 12 to 13 times against a history nearer 25. That gap between what a business earns and what the market will pay for it is the exact thing this method was built to hunt. Then turn to the balance sheet, which is where this method actually lives. Current ratio of about 1.08. He wants 2. Net current assets deeply negative. And the asset side is thick with goodwill from decades of acquisitions rather than anything you could sell in a bad year.
Pass and notice the reason, not the customer, the balance sheet. This method would have passed in 2019 too, when everything was fine.
Now the one that matters, depletions negative in 6 of the last 7 reported periods, 1 positive quarter in the middle of it, then flat again. There is no confirmed inflection in that series. There is the hope of one which is a different asset entirely. And there is no forward anchor left. The guidance that would have given anyone a number to trade against was withdrawn by the company itself. So you are buying a turn with no evidence of a turn, and no forecast to test yourself against when you are wrong. The driver behind all of it is not a product cycle or a price war. It is a political variable that runs for years and carries no scheduled resolution. This method exists to avoid precisely that, not out of pessimism, because there is nothing here it knows how to hold.
Pass, the cleanest no at the table, and the only one that names the actual reason out loud. By 2 conditional, 2 passes, and the 2 passes have nothing to do with each other. Graham never got past the balance sheet. Druckenmiller never got past the trend. Composite 4.4, a spread of 6 points, 2 against 8. That spread is the finding. When 5 disciplined methods land that far apart on one identical set of facts, they are not arguing about the price. They are arguing about whether this can be underwritten at all. Greenblatt buys because his method is built not to look at the reason. Every method that does look at the reason stops dead.
I don't think it is unpriceable, but I do think it is only underwritable as a stress case, not as a normal moat re-rating. If the demand pool itself is impaired and management has no lever to reach it, the multiple has to assume no clean mean reversion. The closest consumer analog to me is Estée Lauder's exposure to Chinese travel retail and Chinese beauty demand. Strong brands, but when the customer flow or wallet simply is not there, the brand moat cannot force the revenue back.
I believe the risk is fundamentally unpriceable, making it uninvestable until the demand shock itself shows a clear and sustained inflection. When management withdraws its own forecast, it's an admission that their models are broken, and we cannot substitute our own with any integrity. The closest parallel is the exposure a major poultry producer has to an avian flu outbreak. No amount of operational excellence or marketing can directly counter that kind of exogenous event.
Which brings it back to the half of the United States beer business. The entire valuation reduces to one question, and no model on this table has a field for it. Does that half come back? 3 tests in order, 2 consecutive quarters of positive depletions, not one. Guidance reinstated because that is management telling you it can see again, and the zip code gap closing because that is the mechanism itself. The first of those is due at the next report.
Here is where I land. This is either a wonderful business at a genuine discount, or it is a permanent repricing of who the customer is. And the difference between those two is not financial. It is whether a group of people feel safe walking into a shop. I cannot model that, neither can anyone on this board. Nothing here is financial advice. These are models of public methods, not the people themselves. The formula is buying a number. Everyone who looked at the reason stopped. If you keep one line from tonight, keep this one. A moat tells you whether somebody can take your customers. It cannot tell you whether your customers are afraid to leave the house. That is not a gap in Constellation. That is a gap in the tool. Tell me which of the 5 you would have sided with. See you at the next session.